This is Module 12A, and the subject for today in this particular module is cost, volume, profit, or break-even analysis. And this is really a continuation of cost behavior and cost structures as we started in the previous module, which was Module 11. Let's turn back to Module 11 and look at the 4 practice that you did to review the concepts in that module, and I'll provide the answers for you to those 7 questions. As you will recall, when we studied Module 11, we were studying cost estimation and using regression analysis to come up with a total cost formula. So these 7 questions are going to relate to that, and we began by identifying the independent variable in this situation. This would be the dollar sales for the quarter. The dependent variable would be what it is we're trying to estimate or predict, and this would be Sgna cost for the quarter. When we look at the 3rd question, we're talking about the R square and what that means. The R square is saying that 74.38% of the change in Sgna cost can be explained by the change in sales dollars for that same period of time, a quarter. So the R square is telling us how well we have chosen the cost driver. In this case, the cost driver being that independent variable called dollar sales. So we are able to explain 74.38% of the change in Sgna cost through the changes in the dollars of sales. Number 4, it asks us to write the cost formula for this situation. So this would be Sgna for the quarter equals the fixed cost being $148,000, the variable being 0.42x, where x equal dollar sales. Number 5, predict Sgna cost if the quarterly sales amounted to $400,000. So we would do it this way. X would be $400,000. And when we do this, we will end up with an estimated Sgna cost of $316,000. Number 6 asks you to compute the Sgna cost per dollar of sales. So we have Sgna divided by sales, and we get an answer of 79 cents of Sgna per dollar of sales. And finally, on number 7, it said, what if we end up having an R square that is only 0.2438 instead of 0.7438? Well, this would tell us that the cost driver that we have chosen is not doing a very good job of explaining the changes in these Sgna costs, and we would perhaps want to add additional variables. And if we would do that, then we would move toward what we call multiple regression. And if we are choosing good cost drivers, additional good cost drivers, you will see that R square climb as additional cost drivers are added. Today's Module 12A is concerned with break-even analysis, or CVP analysis, cost, volume, profit. Again, it is a continuation of looking at the cost structure of various organizations and how their level of variable versus fixed cost affects fixed profits as things change. So we want to find the point, first of all, where an organization will exactly break even. Break even means that the revenues are exactly equal to the total cost. Another way to say that would be your sales equal your variable cost plus your fixed cost. And a third way to say this is at the break-even point, net income is zero. Now, in order to understand break-even analysis, it's important for us to understand the concept of the contribution margin. The contribution margin is the difference between the sales price and the variable cost. For example, if we have a sales price of $7 for a certain unit, and the variable cost of that unit would be $2, contribution margin would be $5. What this says to us, and why this is so important when we look at break-even analysis, is this difference, the 7 minus 2, the sales price minus the variable cost, the $5 contribution margin. What this means is each unit contributes $5 towards first the fixed cost, and once the fixed costs are covered, the contribution margin will go directly to profits, $5 at a time. So to get us back into thinking about variable and fixed costs and getting ready to compute that break-even point, let's take a look at an internal income statement a company would use. And this one is set up to show us that contribution margin. Let's look at an example here and use some very easy numbers. If we had $100,000 of sales and $60,000 of variable cost, we would have $40,000 of contribution margin, perhaps $25,000 of fixed cost, and we would get a net income of $15,000. Now, what we want to think about here is what this contribution margin means. This means that we have $40,000 to first cover all the fixed cost, and once we're beyond covering the fixed cost, we are going to be able to use every bit of the contribution margin toward net income. For an example here, let's say the sales price is $10 a unit, the variable cost is $6 a unit, the contribution margin is $4 per unit. We can express the contribution margin on a per unit basis, sales price, variable cost, contribution margin, or we also can compute it in terms of a percentage. 40 divided by 100 means we have a 40% contribution margin ratio. So this is the CM ratio, and this is the per unit contribution margin. If contribution margin is 40%, the variable will be the inverse, in this case 60%, and your sales are always 100%. The example we're going to use for several of our problems that I will demonstrate are going to use this scenario where we have perhaps a minor league baseball team, and we're trying to determine the break-even point for this particular organization. And this organization is looking at making some decisions, and so they're doing some kind of what-if analysis. And it's very, very useful to use break-even analysis for this kind of sensitivity analysis where we try to predict what's going to happen when we make various changes. So let's talk about the cost structure of this local baseball team. For this particular organization, the tickets to the games are sold for $7. The variable costs are $2 per ticket, and so we have a contribution margin of $5. As you note, these are expressed per unit, but when we come to the fixed cost, we're going to talk about them in total or per season, and for this organization, it's $450,000. So we could write the formula for this particular organization, the cost formula for a season. The total cost for a season would be $450,000 of fixed plus 2x, and x equals the number of tickets. Now let's talk about what we will do with this information. I'll be working 7 different short problems with you, and we will number these as we go, but these represent the types of issues or types of analysis we can do in terms of CVP or break-even analysis. So number 1, we are going to try to find the break-even point. The break-even point is going to be the point, again, at which all of our costs are covered, but we have no additional contribution margin to go toward net income. So net income is 0. Well, let's talk about what we said earlier, that the contribution margin, the $5, is going to chip away $5 at a time against this fixed cost of $450,000. After we have sold enough units to cover the $450,000 of fixed cost, every unit past the break-even will contribute $5 towards the net income. So to find the break-even point, we simply take the fixed costs that need to be covered and the contribution margin per unit, and it's going to take 90,000 tickets to exactly break even. Cost and revenues are equal. Net income is 0. The second type of problem is a what-if type of problem, because we should be able to predict net income if we know the distance from the break-even point. And our break-even point was 90,000 tickets. For example, what would happen if we sold 90,001 tickets, or 1 ticket past the break-even? Then we would say that we are contributing $5. That's 1 unit's contribution margin past the break-even, and this would be our net income. What if we sold 100,000 tickets? Well, in this case, we're going to be able to predict net income by taking $5 times the distance past the break-even, which would be 10,000, and we would have net income of 50,000. Now let's go the other direction. What if we come up short on our net income? What if we sold 85,000 tickets? Then we are short by 5,000 tickets, and that tells us right away we're going to be in a loss situation. So we're going to have $5 times 5,000 tickets that we're going to come up short, and we will have a net loss. Again, this is made very easy because I know that I was 5,000 units shy of the break-even point. 5,000 units times $5 gives us the $25,000 net loss. The third thing we can do, which is very handy with break-even analysis, is we're generally not satisfied just to break even, and we may have a target net income. Let's assume our target net income equals $400,000. Now what our contribution margin is going to have to do, $5 at a time, is going to have to cover the fixed cost, and then we need to sell enough units to also cover $400,000 of profit. So this becomes a very easy formula. Fixed cost plus the target, net income, which was $400,000, divided by $5 contribution margin per unit. And this gives us 170,000 tickets. What we're saying is if we sell 170,000 tickets, we should have a profit of $400,000. Now the next thing that's helpful to do is to always use our variable costing income statement that we saw earlier to help us prove our answers. If we ever question our analysis, we can always go back to the basic variable costing income statement, and you'll recall from an earlier chapter that this particular statement is only used internally. This would be highly confidential information. So let's check out the answer that we got to number 3. It's saying that if we sold 170,000 tickets, that we would end up with $400,000 of net income. Please recall the sales price is $7, so we're going to sell 170,000 tickets. So we'll get sales of this amount. We know that our variable cost would be $2 times the number of units. So this gives us $340 and gives us a contribution margin of $850,000 minus the fixed. And we are able to prove that this indeed will give us $400,000 of net income when we sell 170,000 tickets. So let's label this number 4, and let's describe this as using our income statement to check answers. Now we could always work it this way, it's just much longer, and it serves to be a really good proof of some of the techniques, the quick techniques that we are learning, and it's always a good idea to go back to this and make sure that we indeed are getting the correct answers. Number 5. We talked about wanting $400,000 of net income, but when managers say that, they typically are referring to that being after tax. So number 5, we are going to convert after tax net income to before tax net income. And this is a very easy computation. We just take the after tax and divide by 1 minus the tax rate. Let's use in our example a rate of 20% or 0.2. So this would be 1 minus 0.2 or 0.8. And when we divide 400,000 by 0.8, we get $500,000 before tax net income. Now, if you'll notice what we did before, we put our target in at 400,000. But now we want to talk about it in terms of before tax. So let's recalculate our break even. Excuse me, it's not a break even, it's a desired or a target income. Let's recalculate the target income sales level that we will need. We will take our fixed cost plus before tax net income, and we'll divide by the contribution margin per unit. So this was $5, and we had fixed cost of $450, and we have before tax profit now of $500,000. So we will need to actually sell 190,000 tickets. Now, as you can see, our break-even point, or our point which we will make the target net income, has gone from 170,000 tickets to 190,000 tickets. And that's because we have moved the after-tax net income to a before-tax basis. One of the things that this local baseball team is looking at doing, instead of just selling general admission tickets for $7, what they want to do is some capital expansion in the stadium and build some nice box or club seats. And they want to sell now 2 different kinds of tickets. They want to sell general admission and box seats at a higher price. Now, when you do this additional capital expansion, you will see that the fixed costs are going to be changing too. So this is a good example of what-if analysis. What if we sell something more than general admission and we actually sell 2 levels of seats? Where will our break-even point be? As we address this issue, we have to determine, and again, this is just an estimate, what percent of the sales do we believe will be made for general admission tickets? What percent will be made for the box seats? The general admission tickets are going to be dropped to $6, and the variable cost remains at $2. So we have a contribution margin now of $4 for the general admission tickets. For the box seats, we're going to try to sell those for $15 with a variable cost of $2. And a contribution margin, of course, very high of $13. Now, as I mentioned earlier, we're going to have to predict the percent that we believe we will sell of each. So we are going to estimate 80% general admission, 20% box. What we will need to do is compute a weighted contribution margin. So we will take 0.8 times the $4 for the general admission plus 20% times the $13 for the box seats. And when you do this computation, we get a weighted average contribution margin of $5.80. Now we can take our fixed cost. And what has happened, our fixed cost used to be $450,000. It is now $550,000 because of the additional work that we've done on the stadium in terms of facilities. We will take the new fixed cost and divide by the weighted average contribution margin. And to break even, this company will need to sell 94,828 tickets. So this is the break-even point. And if you recall, if you go back to number 1, when we were only selling one type of seat, we had a break-even point of 90,000, and now it is higher than that. And what we can do is we can turn this into how many tickets of each type would we be selling. This would be the 80% for the general admission, which would be 75,862. The 20% of these tickets would be box seats. Now, of course, we could find the revenue that we would earn on each type of tickets or each type of ticket. For example, if we were wanting to know how many dollars of revenue would be generated at the break-even point through the box sales, then all I have to do is multiply these number of tickets by the sales price for the box seat. So that would be times $15. And that would give you your revenue at the break-even point for the box. So when we have 2 or more products, the point here is we have to calculate what's called the weighted average contribution margin. And once we find it, then we can find the break-even point. But please understand, this break-even point will only be correct when we sell 80% and then 20% for box seats. And this whole thing rests upon those percentages. If those percentages turn out to be different, then we would have a different break-even point. Let's leave the baseball example behind for a moment and move to our last type of problem, which is about scarce resources. And we're going to move to the manufacturing environment because it's easier to understand in that context. For example, if we have a limit on the number of machine hours, we may be making 2 or 3 different products, and each of these products would have a different contribution margin. If we're trying to decide which product to prioritize, we're not going to base it on which product has the most contribution margin, but what we want to find out is how much contribution margin is earned per scarce resource. So in that example, we would compute the contribution margin per machine hours, because machine hours is the scarcity. Now, we have a TV station example we could look at too in the service industry, and let me give you a little bit of information about it, and we'll talk about how to determine which product to prioritize when we have a scarce resource. In this example, the scarce resource is going to be editing hours. Perhaps we don't have enough editors on staff, and so we really have to look at how we want to use our editing hours. Do we want to use them dealing with short commercials, long commercials, or short public announcements? These would be, for example, in this particular industry, our products. Well, the short commercials have a contribution margin of $2,500, the long commercials $5,500, and the short public announcements have a contribution margin of $1,800. Now, if we have a scarcity, and we do, it is editing hours. We don't have enough editing hours. We want to divide each of these contribution margins by the number of hours one unit requires. So short commercials require 4 hours of editing time. Long commercials require 11 hours, and short public announcements require 3 hours. So we compute what is called the contribution margin per editing hour. In this case, it would be $500 CM per editing hour, and this would be $600 of contribution margin per editing hour. So when we look at it from this perspective, we're able to see that if the demand is there, we should be producing as many short commercials as we can. And that's a big assumption, to always assume that the demand is there. So we would want to be sure that we worked with our marketing department on the demand for each of these products. But assuming that the demand would be there, the best use of this scarce resource would be to use it for short commercials, because it has the highest contribution margin per scarce resource. Today in this module, we have looked at 7 different types of problems that we can do using break-even analysis or cost, volume, profit analysis. This type of analysis is very common for management, and very, very helpful as we try to predict what profits will be as situations change.